Hello and welcome to this pre-budget special show titled What Markets Want. And that effectively will be the discussion over the next 30 minutes as to what is it that the markets want and how will the markets react if indeed it gets delivered. And to talk about that, two eminent experts need no introduction. Saurabh Mukherjea and Vikram Kotak join in to speak about their sense of how the market is positioning itself ahead of the budget and what the likely reaction could be. Gentlemen, both of you, thanks so much for joining in. Vikram, the obvious question that comes to mind is that with a lot of serendipity at work for India, the lower oil prices, excise benefits, lower fisc pressure on the government, he's probably the luckiest finance minister in the last maybe 10, 15 years. Is the stage set for meeting the fisc deficit targets for this year and the next year and being on a sound footing for the GDP as well?
Absolutely, you're right. I think I've not seen this kind of enviable macro situation since 8-10 years. I'd seen last in 2008 where oil was fallen to some $40 average. And I think it's the best situation for finance minister and a lot of hope and a lot of expectation around. But I think the best way to look at this budget is to how do you take this tangible benefit which this economy has got through the global slowdown and the fall in the oil prices. How do you bring that tangible benefit into the use? Like, to give you example, if you have 0.8% of the GDP has been saved because of this oil price fall and some buoyancy in tax, how do you bring back to the system? How do you spend that? I think that's the whole focus of the budget. How do you bring that growth which is elusive at this point of time? How do you bring that back into the in the circle? That's the theme of the budget.
And Saurabh, that's precisely the point that I want to get you in. Can he afford to be a little profligate? People like Arvind Panagriya has said, that perhaps it's wiser to be loose in FY16 and, kickstart capex. That is what one really needs on the ground right now. Can he afford to do that this budget?
I think there'll be two priorities that the government will have to heed. I think the first is the 14th Finance Commission recommendations. They're not yet public, but basis what the press is saying, my hunch is that the government will be forced to increase the amount of money it gives to the states. So much of the oil price related windfall, so 0.5%, 0.8% of GDP, much of the oil price related windfall will go in, the center giving the states more money. Coming on to the point you're making, you're absolutely right. The Niti Aayog Vice Chairman has made the point, the Chief Economic Advisor has made this point that we need public sector capex to revive the economy. I'm not going to get into the debate of are they right or wrong, but my hunch is the government will heed this point of view. I think we are likely to see the biggest blast in government capex that we have seen in a good 10, perhaps even 20 years. That will probably be another 1% of GDP. And overall, ironically, in spite of the windfall benefits from crude, I think he'll have a really tough time getting to 3.6%. Like every FM, he'll promise a 3.6% consolidating budget, but the maths we've been crunching, after giving more money away to the states as per the Finance Commission recommendations, and after spending a 1% of GDP on capex, you're left with a very tight budgetary position.
Will the market be okay with it? That's the point.
I think at this juncture, given the mood of the market, and given that even investors and brokers such as us, we can see that there is no capex happening on the ground. No private sector company that we can see is contemplating major capex. I think most people will say, let's give the government the benefit of the doubt and let's allow them to embark upon a capex drive. The challenge, I think, is actually, can they deliver on the capex? Can the capex actually take place any time before Diwali? That's my greatest concern. My greatest concern isn't the announcement of capex. I think it'll happen. The market will take it reasonably positively. The challenge is, given the sort of weak execution powers of the Indian state, can they actually get anything going in the next 6-7 months?
Vikram, the jury would be out on whether or not he will meet the 3.6% or no. And I know the opinion is divided right down the middle. Now, let's work with an assumption that he does meet the 4.1 target and he does say that he will stick to 3.6. But does he have the leeway to leave more money at the hands of the consumer? Because that is something that a lot of people are asking for as well. Maybe some tax benefits, a couple of other measures, which will get the consumer, rural or urban, back into the spending mode. Can that happen this time around?
Yeah, I think the point which Saurabh was making, I just want to add one small thing to that. The whole argument of capex has to start with the public sector, because if you expect private sector to come and start the capex, it's not looking so feasible because they are stuck with a large project and they are expecting a sustainable, predictable government policies first and government action first to kind of start the capex. So I think the public capex and plus the saving which they have in their hand, the public capex should be a first one to start with. And coming to the point which you made about the giving the more money in the hand of consumer, I think there are many opportunities. I think there are so many small issues which you can really solve upon. Just to give example of dividend distribution tax. Now, a normal individual and a corporate and a promoter, everyone pays the same amount of dividend distribution tax. You don't need to collect so much of money from the retailer. Pensioner should not pay a dividend distribution tax. So you can create a threshold limit for the dividend distribution tax and rest should be charged at the same rate. That's one of the way to giving the money back. The interest subsidy on the housing loan can be increased. You can always have some small tinkering with the limit. There is a leeway. In my view, there is a leeway to increase the small areas and also focus on expenditure which is a more productive in nature. I think these are the area if the government focus upon, I think there is a lot of room available and I'll be not very worried about 3.6 or 3.7 or 3.8. Even if you do 3.7 fiscal deficit with more money in the hand of consumer, more stimulus to revive the capex cycle and infrastructure spending, I think that budget will be better budget than having 3.6 but curtailed planned expenditure, curtailed non-planned expenditure. I think it has to be balanced rather than going on that 3.6 number.
So Vikram, just taking a leaf out of the point that Saurabh was making, how would the markets react if the budget is subpar? And by subpar, I mean, what if he gives a lot of money for social spend, but it doesn't eventually turn out to be productive?
I think market to react initially is a very different argument. But in my view, if you look at it, the short-term condition in the market right now that we are seeing a lot of earnings downgrade happen in the last quarter. I think most analysts on the street will downgrade the FY16 number by a couple of percentage points. The market has run ahead of the expectation of budget. I think 8% up YOY. I think market, in my view, if you ask me about the market outlook, I think market is going for a consolidation for some time. Market will react maybe 5-10% plus minus in particular stock or sector on the budget announcement, but ultimately I think everything will settle down and we expect this announcement to really take shape going forward. So market is looking to kind of more execution, action, implementation now going forward, because we already had a extreme pessimism in 2013 to a fair value zone in 2015 start. I think we already kind of covered a lot of ground in terms of market returns. Now it's a time where market need to kind of subside on one side and the real execution, the real implementation should start. And luckily, as we started, I think India is in a sweet spot where you have everything is in your favor today. The government is for long term, they have a full mandate, you have the oil price, everything is in your favor today. It's your time to really kickstart the whole implementation and the execution process soon, and we don't have time.
Okay, we'll talk about whether that happens or no in the budget itself and what are the sectors that will benefit if indeed that happens. That's coming up on the other side of the break. Stay tuned.
Well, we're still in conversation with Vikram Kotak as well as Saurabh Mukherjea and trying to analyze what the market really wants from this budget. And Vikram Kotak is of the belief that perhaps the market would consolidate from here. It could be a knee-jerk 5 to 10% reaction here or there, but eventually what the market really wants to see is how the execution is actually going to be done on what is announced in this particular budget. And Vikram, just to make a point, or rather take a question from the point that you were making earlier on, a lot of hopes are riding high on spending on different sectors, be it infrastructure, rural housing, roads and transport, etc. How much of it is already in the price, or do you think that when these announcements come, which indeed they will have a multiplier effect in the stock market?
I think a lot of things are there in a price. I just looking at some of the stocks in the railway sector. I think they all moved up by almost 50-60% ahead of the budget. So many sectors have already shown that the pre-budget rally kind of move in the many sectors. But there are long-term benefit of all these sectors, because you are sitting in a very good situation where most companies are sitting on a lower capacity utilization. The whole capex cycle is yet to kind of take off. The whole commodity price benefit is yet to come. So you may see this reflecting in earning in FY16 to some extent, and FY17 in larger extent. But to have a huge rally from here, unless you have a dramatic change in the budget, like for example, if budget says that there is no MET on SEZ, then I think the SEZ stock can really bounce big way, because from 20% you go to 0, which is not going to happen in my view. But I'm just saying that if you have something dramatic reforms, a dramatic announcement for a particular sector, then you might see that that reflects in a short-term rally. But in a medium term, if you ask me, I think these sectors like cement is going to be biggest beneficiary. The housing sector, the low-cost housing move, which is likely to kick off, which is the housing finance, housing around those sectors, I think going to benefit. So urban consumption will be a beneficiary. But I'm not expecting immediate big movement post-budget on any policy announcement. You may have a couple of 5-10% of gain in particular stock or sector, but overall I think market is headed for I think market want to see the numbers. I think here the market want to see the visibility, the numbers, and the earnings growth in the stocks.
Saurabh, one anticipation is spending on power and T&D, power ancillaries, etc. That will be stepped up in this budget, and probably seems to be a given. How would you look at that announcement, and how do you think the markets will take it?
I think as Vikram was saying, the areas where capex is likely to be going up have been already so hyped up that it's difficult to see whether on the back of 28th February as an event there's extra alpha to be delivered. But I agree with you, given the Prime Minister's focus on the Jyoti Gram Yojana, which is by 2018 power in every village, it is highly likely that T&D will be an area where there will be a meaningful step up in spend. And our point of view to clients over the last couple of months has been, you can look at it three different ways. You can either look at the equipment providers, and Alstom T&D we would put right at the top as the premier equipment provider to the T&D sector. You can look at the companies which provide EPC services to string the cables and the transmission towers up. So Techno Electric would be our the main EPC provider we will look at. And finally, you can look at the owner of the assets, PGCIL, regulated entity, steady Eddie name. So if you're interested in long-term investing, I think all three are well-run companies. If you want a post-budget pop, I'm not so sure how much room there is for a post-budget pop, given that these stocks have already factored in some of the optimism, just as the low-cost housing plays have done, just as the defense plays have done. But if you want three fundamentally well-run companies in a theme, which I think is here to stay, T&D I think is here to stay as a theme, the Prime Minister is very focused on it, the Power Ministry is very focused on it, then Alstom, T&D, Techno Electric, PGCIL are perfectly sensible companies to look at.
Sort of housing as well has started to move up as a theme. Now, can housing for all, smart cities, etc., really lift up the market sentiment when it comes to these sectors and balance sheet of these companies? Or would it be at best a trading pop or an anticipation or hope trade which is currently playing out?
I think whilst there will be announcements in the budget, highly likely to be announcements in the budget in terms of interest subvention for affordable housing, which I think is, a 15 lakhs or below, there will be interest subvention. There might also be tax breaks and SOPs for developers who build affordable housing. My hunch is that the affordable housing story will run into headwind. It will run into headwind because the rural India story, the aspirational consumption story in rural India is coming under serious pressure. For the last 5 years, government subsidies in UPA2, last 5 years have gone up at a CAGR of 19-20%. Now the NDA has put the brakes on that sort of growth in government subsidies. I doubt the NDA will hit the accelerator at quite that rate on government subsidies in this budget. So the aspirational consumption story in rural India, which was so central to all of these plays thriving, the cables companies, the cement companies, I think that those plays will see earnings pressure because of the rural India story pulling back. So yes, at one level, the budget will act as a positive catalyst for plays around low-cost housing, Finolex cables, for example, or Orient Cement, which are largely plays around low-cost housing. But at another level, I think there's earnings pressure for at least 2 to 3 quarters around the entire rural consumption story.
Oops. Let's see how that goes. Yep, I think people are starting to probably bet a lot on urban consumption as well. And Vikram, which brings me to my question to you. I heard you mention that you believe cement could be a big play as well. Is it because of the obvious benefits that come in due to the infra spend? Or are there other allied factors as well that will go a long way into cement doing very well as a sector?
I think the opportunity in cement is multifold, Niraj. One is clearly the cement companies are not at the peak of capacity utilization, so there is a lot of operating leverage available, because if you look at average utilization levels are close to 75 to 78% range. So there is opportunity to take that to 85, 90, 95%, depend upon the how growth really comes back. You have the big benefit of this whole coal mining issue is kind of sorted out, so you'll have a lot of visibility on the coal available in next couple of years, plus the imported coal prices are at a much lower level, so you get the translation benefit of this coal prices coming back to the cement companies once they finish their inventory losses. And third, of course, the overall infra on manufacturing boom which we are talking about, if it is kickstart, which is likely from this budget, then the cement is the obvious first beneficiary of all this. So cement is actually sitting on a sweet spot.
Okay, from sweet spots to outliers, are there other pockets that will benefit indirectly as a result of measures announced in the budget? That is something that we quiz Vikram and Saurabh on the other side of this break. Stay tuned. All right, back with what markets want from budget 2015 in conversation with Vikram Kotak and Saurabh Mukherjea. And now, let me take it to Saurabh and ask about a few outliers, so to say, and which may have a bearing on the markets. Sort of the last few days, the market is seemingly spooked, if I can use that term, with the possibility of long-term capital gains tax coming back. And while it may be desirable, I think there are a few quarters which do not like it as well. Now, my question is, will the markets react negatively if that happens? And two, does it have an impact on say, brokerage stocks, for example, if indeed that does come in?
The way I would look at it, I think there's a broader theme at play where I think there's scope for disappointment. The broader theme at play is several investors and perhaps even people in my brokerage community have built in this point of view that this government is somehow, pro-business out there to help the business community. I don't see any of that. I think the government is a pragmatic government focused on lifting the economy, focused on doing the right things for the vast majority of the population. And hence, as the sort of quarters go by, there's scope for greater and greater disappointment as this very pro-business point of view that the market was expecting simply doesn't materialize, because I don't think the BJP will go out of its way to help either the investor community or the business community. They're here to strike a balance between conflicting stakeholders. On the specific point of capital gains, yes, it's an old chestnut. If long-term capital gains does come back on, it will be a disappointment for the brokerage stocks. But it is what it is. I think the broader theme is what worries me. I still see a lot of undue optimism in the investor and brokerage community about what this government will do for that community, which I simply don't find founded on fact and reality.
Okay, Saurabh clearly is treading with caution, but Vikram, I want to chat a few more sectors about, with you. If the finance minister does indeed leave more money in the hands of the consumer, how positive a move could it be for sectors like FMCG, jewelry companies, the consumption theme? Is there a one-on-one correlation really?
It is not directly, but yeah, it will definitely benefit over a period of time to these companies. But I am not looking at, if you ask me, that whole sector, the whole FMCG or consumption is again ahead of the times. The valuations are pretty expensive. So I am not, it may add up to some growth in this sector, but I'll be rather more focused today on how do you bring this, instead of going to this long-term capital gain tax inclusion, which is very regressive, how do you bring back this Make in India, this infrastructure? If you do that steps right, I think it will benefit the whole economy in a big way. But I'm not expecting, as Saurabh said, and I repeatedly said that my view on the market is that most of the things have ahead of the time. It's run before the things really materialize. I think it's a time to kind of take a pause for maybe 4-6 months, and let's see how the economic activity improves on the ground, and then possibly the market will try to kind of take a next level of move on upward or downward. If you have something like this long-term capital gain coming in, then I think forget about it. I think this is going to really dampen the whole India story which we are trying to talk about.
GST roadmap, Saurabh, now that's a given. Will the markets react to it, or is it already in the price?
No, I think the GST roadmap's given. What the market will react to is how much traction the government gets in Parliament generally. If they can't get normal bills through Parliament, then clearly GST, which requires a 2/3 majority in both houses of Parliament, is a sort of complete no-no. My reckoning is we'll head into joint sessions for pretty much everything. And if we head into joint sessions even for more routine ordinances like the minerals one, don't quite see how quickly GST can go through. I think there is another area where you'll see beneficiaries, because what's happening is as the months are going by, it's relatively clear the government simply doesn't have the money to recapitalize the public sector banks. I mean, the amounts of money they're allocating is probably 1/10 of what the PSU banks need over the next 12 months to actually have breathing space for growth. Inadvertently, I think it'll help the private sector banks, the NBFCs, and the better run private sector banks and NBFCs should have a good 2 to 3 years as the PSU banks find themselves completely starved of capital. So the way to sort of think about the budget is, in a way, the obvious plays are already sort of run up, as Vikram was mentioning. What hasn't run up is sort of less obvious plays. So one would be the private sector banks, the private sector lenders. The second would be agro-tech companies. There's a clear need in India to boost fruit, veg, poultry, dairy. For that to happen, you need to create cold chain, you need to create food processing capacity. And as that happens, agro-tech companies, which supply fungicides, herbicides, pesticides, fertilizers, seeds, those companies will find traction. Now, whether there are tax benefits for them, I don't know. But in a way, if you look at the budget and you step back and say, what is the government trying to do at a structural basis, you'll probably get more joy in terms of identifying winners rather than the usual thing that my profession does, which is to measure one and 2 winners and 3 winners. Step back and look at the bigger structural picture, and I think you'll spot more winners from the budget than from the specific fine print of the budget.
Okay, those are final thoughts from both our experts. Vikram, Kotak, Saurabh, Mukherjea, thank you so much for joining in on this leg of Budget 2015, What Markets Want. It's been great having you guys, and thanks for taking the time out today. And with that, from Ayesha and me and the team that put this show together, thanks so much for watching.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.